Today we're going to talk about GP and LP structures, what they are, when they may be useful, and some of the spin-off opportunities that are available if it turns out that the GP-LP structure is right for you. I'm George Duby, saving the world from tax, one bow tie at a time. So to start off with, an obvious question is, what is a GP and LP structure? The GP stands for general partner. The LP, limited partners, or limited partnership. The general partner, think of it as the founders of a company, the founders of the real estate project. They're going to have an entity that is going to complete the management, the activities of the real estate project. The limited partners, through the limited partnership, are providing the funds, or the predominant portion of funds, for the project itself. And these are going to typically be, not required, higher net worth individuals, and they may be looking for certain tax advantages or reporting requirements or advantages, financing advantages. There's a host of reasons that someone may be looking for the opportunity to be a limited partner. The founders are looking for the opportunity to bring the limited partners into the fold for the investment while ensuring that they have control over the operations. Let's move over to the elements of that GPLP structure. In the simplest format, there is going to be the limited partnership itself, and graphically, for whatever reason, in Tax 101, accountants are taught, thou shalt draw an oval for a partnership. So when you take a look at our structures, this may help you interpret a little bit what's going on. That limited partnership is going to have one or more, typically it's going to be more, limited partners. And in turn, it's going to have a general partner. Traditionally, that general partner is a corporation with very little in terms of assets, and normally, not always, normally owns a fraction of a percent of the limited partnership itself. That general partner is going to be doing what I'll call the majority of the activities in terms of running the limited partnership. The limited partners, as I understand it from a legal perspective, keeping in mind I'm not a lawyer and you need legal advice, are not allowed actually to be involved in the management of the company, or in this case, the partnership. If they do get involved, they may, and again, talk with your lawyers, lose their limited liability. So a huge incentive for the limited partners not to be involved in managing and directing what's going on with the project itself, and a huge incentive and ability for the founders, the owners of the general partner, to take care of business, do things the way they want, provided they're meeting the requirements and fulfilling the agreement of the limited partnership itself. So we've seen a more simplistic and basic GPLP structure for what a lot of real estate investors like to see. But that structure can become more complex, as you'll see in this graph. And it's not to say that you need every element of this. We're trying to present some possibilities that you should be talking with your advisors about in terms of whether or not it's right for you today, or maybe it's something that you morph into over a period of time. So starting that off, one of the things we often speak with people about is whether the founder should have a nominee corporation. So a nominee corporation would actually hold title to the real estate. For some legal reason, the limited partnership itself is not allowed to hold title to the real estate. And so it's usually going to be either the general partner, that corporation we discussed, or alternatively, a nominee corporation. And while from a tax perspective, I'm not aware of any difference, from a legal perspective, I've been told, and again, something to confirm with your legal team, that the nominee corporation may be of assistance from a land transfer tax perspective in terms of some possible transactions in the future. Other things to be considering. Should there be, for the founders, a management company? A management company may take some of the activities away from the general partner. So if the general partner is in some way almost a magnet, if you will, for lawsuits, then we don't necessarily want to see a whole lot of revenue stream going through the general partner. Based on the advice from your legal team, we may then set up a separate management company where that income can flow through to. So for example, there may be an operating fee, a guarantee fee, a closing transaction fee, a financing fee, a this fee, a that fee. There can be a multitude of different fees, provided that the investors are accepting of these through the limited partnership agreement. We may, in addition to that, have an investment company created. That investment company, it's the intention there for the founders, instead of just having a relatively small fraction of a percentage of ownership, they may actually as well be putting some cash into the project and want to isolate the investment away from the general partner. So setting up a separate company to hold their investment within the LP is often something that makes sense. We may, in many cases, create a family trust. That family trust often owns that management company, the investment company, may also own something called a beneficiary company. And without getting into all the details, it may be thought of as almost a storage facility for cash flow. There can be legal and tax reasons for that. We can go another step. And again, this may not be on day one, and often is not, quite frankly. But we may set up what I'm going to call a TOSI family trust. And largely the purpose of that is to be able to split income with the founder's family while meeting requirements from Revenue Canada in terms of how we can and can't do that splitting. So on day one, we may have a very simple structure, but it may be something, again, we grow into a more complex structure over time. You need to be discussing with your accounting and legal advisors and finance advisors, quite frankly, what that structure should look like for you and when you should go to the next level. In terms of pros and cons of using the GP and LP structure, let's think about this from the founder's perspective. First, and again, different people will have different areas of focus, but it allows the founders, probably speaking, to be getting involved in larger projects, perhaps even more diversification than they otherwise would be. It allows the founders an opportunity to control the project. It allows the founders an opportunity to have one less reason for an investor to say no, because they're going to be able to tailor their own specific tax and legal situation to their best benefit as compared to the structure you may be otherwise creating. That flexibility may allow for you to really get the attention of more investors. An add-on benefit for founders of a GPLP structure is what the structure itself could change into down the road. It's possible, perhaps it sounds frightening initially, but it's possible we may want to change into a private REIT, a real estate investment trust, maybe even want a public one down the road. But starting with a GPLP structure allows you to more tax efficiently, potentially, depending how you're trying to do things and what you're expecting for those initial investors, it may be more tax efficient to change or to evolve into that private REIT. And it sounds intimidating, I acknowledge. The REIT may allow you to get after registered funds. Think of RSPs, TFSA money. The REIT may also allow, quite simply, just more investors to be coming in. It also clearly is a different status, so there's more cost, unquestionably, to setting up a REIT and maintaining the REIT, significantly more than just a GPLP. But the GPLP structure keeps doors open for that tax efficient change that might happen down the road. On the opposite side, there's some more costs involved, no question. A little bit more of a pain in the rear end factor in using that GPLP structure. There's more costs as a result of the complexity, but if that's the difference between getting a project on or off the ground, the cost is relatively minor, particularly if the founders are using this as an opportunity to build a framework for future developments and future projects. You're going to be forced to use December 31st year ends from a practical perspective, and the deadlines for reporting are going to be tighter as compared to using corporations. That all said, if you're using other people's money for your investments, it's not like you had a lot of leeway if you're using a corporate structure, for example. This is simply going to ensure, essentially within 90 days of the year end, your reporting is ready to go. In terms of the pros and cons, or advantages and disadvantages of using a GPLP structure, investors are often looking to the flow-through capability or capacity of the limited partnership. This flow-through ability, kind of in English, means that the activity of the limited partnership is flowed out to the investors, proportionately, typically, based on the amount of funds that they invest. Phrased a little differently, if there's a real estate investment project in terms of simply a rental program, that rental income, less the various expenses, are going to be flowed through to the investors as if they were doing that themselves on their tax returns. Whereas if it was a development project, perhaps the sale of a condo project, the investors will receive, again, a proportionate amount of the activity, the sales of those units, as if they sold them themselves. Often, because the limited partnership does not actually pay any income taxes, the investors like it because they can dictate for themselves how they are taxed. In other words, if they invest as individuals, corporations, perhaps as another partnership, they may have family trusts involved, they may have a joint venture involved, they can do different things. And that will dictate to a large degree, how they are taxed. What makes sense in their specific situation, in contrast to the common example of setting a project up in a corporation, where everyone then who is investing must accept the tax implications of that corporate investment. Other common reasons for using the limited partnership, making clear I'm certainly not a lawyer, but I understand that there is limited liability in many cases for those investors. Further, from a financing perspective, in the vast majority of cases, the limited partners will not be providing a guarantee for the project financing, which again is often in contrast to investing using a corporation. From the perspective of the investor or the founder's component of the investment, let's think about a couple of the tax attributes of the limited partnership itself. So one, I've touched on the idea that the limited partnership is going to flow through its profits, its activities. The limited partnership does not, in and of itself, pay taxes. The limited partnership instead, it calculates how much rental revenue did I receive, or sales revenue, or operating income, rental expenses, these expenses, those expenses. What's my net numbers? What numbers are available for depreciation purposes? That information, typically proportionate based on how much the investors have invested. In other words, if that investor has put in $100,000 to $1 million project, they're going to receive 10% of the profits and various expenses. And by saying it's $1 million project in my example, I mean of the funds invested. So now, if those investors are receiving their income with that flow-through ability, so there's no corporate tax, for example, if there was a corporation used instead of a limited partnership, the limited partners are able to dictate how they are taxed. In other words, if they own it through a corporation, they're going to be taxed as if they had that proportionate income earned in their corporation. Or if they own it personally, or through a registered investment, or through a family trust, or a partnership, or this, that, or the other thing, they can create for themselves what makes sense in their case from a tax perspective. Another benefit to be considered from the founder's perspective in terms of how they phrase things for the investors or the founder's own money is that the limited partnership, because it is not taxed, has the ability to prevent double taxation. In particular, for long-term real estate investors, if they have a structure where they've got a holding company, which in turn owns the real estate holding company, if a project is refinanced, it's quite possible there's a double tax where funds are paid through a dividend from the subsidiary company to the parent company. In a limited partnership example, that does not exist, or rather, the limited partners are able to circumvent those rules, if you will, ensuring they do not get ensnared. So they can set up for themselves a situation that is advantageous for them without hurting anybody else. As well, and maybe it's kind of expected or inferred, but with this flow-through ability, the nature of the income is maintained. In other words, if it was rental income that the limited partnership made, it's rental income that the owners or the limited partners receive. If it was operating income, if it was income from operating a hula hoop factory, whatever it happens to be that that limited partnership is doing, it is flowed through to the investors according to their proportionate interest in most cases. For the founders or the investors that are looking for more details on how, whether it's the rental income, the sales of real estate, the hula hoop factory activities, how they're taxed at the corporate level, keeping in mind that a good number of the investors and probably the founders are going to hold their limited partnership units through a corporation. Please refer to some recordings that we've done describing the active income, the passive income, how these are taxed at a corporate level. So who should be considering a GPLP structure? First and foremost, I certainly believe that is for more serious investors. And don't be offended by the fact you may never have one, you may never need one, you may never want one. That's fine, absolutely fine. But for some extra costs and opportunities, it may fit in with what you're doing, with what you want to evolve to. So and again, this is not something written in the Income Tax Act or something to that effect, but I tend to see the LP structure used more so where there's more than 5 investors getting involved in a project, or simply that the founders are looking to try and create a structure so that those other investors do not have to guarantee mortgages or funds and debt. I also tend to see it more from a marketing perspective almost, where a number of investors, they're to some degree almost taught, it seems to me, that they should be looking for a flow-through opportunity. And we can agree or disagree on whether that's a good idea for them. But if it's the difference between getting a $500,000 check and not getting a $500,000 check as an investment, I'd be pretty clear that that GPLP structure will be there pretty quickly if that's the difference between success and maybe not as great of a success. So overall, where you're looking for a little bit larger projects, more diversification, perhaps some more sophisticated investors, I think this is something you should certainly be looking into. But to be fair, I work with a lot of very, very successful investors that never have had and never will have a GPLP structure. But I also work with a number I think could have been more successful with that structure. So an obvious question is, what's next? How do we actually start the process of setting up the GPLP structure? So first, let's start talking with your accounting team, the legal team, the financing team. Second, we haven't talked about, I'm not an expert at this component, let's ensure that any securities legislation has been addressed. We don't want to find out after the fact we've skipped some steps and you're on somebody's bad side. The third part to this is clearly developing a strong business and investment plan. And that's going to be crucial as we get into the fourth step of really starting to kick off the creation of the structure itself, creating the limited partnership agreement. I found through experience that those that don't really have a strong idea of how they want to divide the profits, create the opportunity, we end up going through a lot more series of revisions, more revisions, more revisions, and every time the agreements are changed, the lawyers are involved, the tax advisors are involved, and guess who pays for all that? So you're going to be a lot happier with some strong ideas of what you would like to see. Then consider the advice provided by the legal tax financing teams. It's not to say don't change the agreements. I don't think I've ever seen draft number 1 be the final agreement. But you also don't want to have, in my personal opinion, drafts 10 and 15 and 20. You're aiming for a much smaller set of revisions. And down the road, as you've created your template for future, and the future meaning limited partnership number 2, 3, 18, etc., unquestionably you're going to tweak the original agreements, the terms, the split of profits, who's involved. But in an ideal world, we're not starting from scratch. No question, this series of recordings on the GPLP structuring is very high level, not a lot of detail. Please feel free to reach out, set up a time to talk further, and we can get into the nuts and bolts for what's right in your specific situation. Have more questions? Please subscribe, follow, and even share. I want all of us to have the tax information we need to do wonderful things.